Hello, everybody, and welcome to Investing with IBD for June 5th, 2019. I'm your host, Arusha Pierce, and with me in the studio today is Justin Nielsen, Market Research Director of IBD. Thanks for being here, Justin.
It's a pleasure. It's going to be fun.
On today's podcast, we're going to talk about the current market, our swing trader product, and a number of our other products, how they help you gauge the current environment. And we're going to end the podcast with some current stocks. And also, we're going to go over a question from one of our listeners. And just a reminder, if you have questions or feedback, send an email to investingpodcast@investors.com. Okay, Justin, let's get into the current market. Now, the market is in a correction.
Right.
And you guys, I was speaking with Chris on last podcast, last week's podcast, and you guys did a great job at calling this correction really early on, using the vertical violation concept that we discussed in the last podcast. But so far we're still in that correction. But we had a strong rally yesterday. Mm-hmm. A decent follow through today or decent.
Yeah,
not
let's not say follow through. Let's be very careful of that.
But a decent second day of an attempted rally. And so it's day number 2 of an attempted rally,
right, on
the S&P and the NASDAQ. And actually, day number 3 on the Dow, if we're looking at that. But we're looking for that follow-through day.
Mm-hmm. So, yeah, let's just real quickly go over what a follow-through day is, just to remind our listeners. The idea behind a follow-through day is that it's not just one day that you need. You need kind of a confirmation of the strength. So what we had already is day 1, and that's just a day that's up.
Day 1 of an attempted rally.
Day 1 of an attempted rally.
The market's going to attempt a rally.
Right. So the market is attempting a rally. You've got a downtrend, and it's trying to rally from that downtrend. Now, as you mentioned, this is day 2, day 3 for the Dow, and what we do is we start counting. As long as we don't undercut the low, then the rally's intact. Once you undercut the low, the downtrend is back in play, and you
so
need to look for another rally.
Right.
Yeah, so you need to look for another rally. So at this point, it's day 2, day 3, depending on what index you're looking for. We need at least day 4 before we start looking for a follow-through day. And what we're looking for in a follow-through day is one of the indexes to be up at least 1 to 1.25%, and volume needs to be heavier than the previous day. Doesn't have to be above average. It just has to be above the previous day. And then that kind of confirms that you potentially have changed direction and you're now in an uptrend. Of course, the caveat there is they don't all work, but we tend to try and do a little bit of buying when we see that follow through day. We really, buckle down and make sure we're doing our searching for watch list stocks. And if it works, then you're getting in pretty close to the bottom, as little as 4 days away from the bottom. And if it doesn't work, you're not plunging in. You're not having, oh, okay, I was 0% invested, now I'm 100%, I'm on margin. It's you let a little bit out, buy a few stocks here and there, and then if they're working, then you could put more money at risk. If they don't work, then you're no harm, no foul. You're going to take a little bit of a hit, but not get hurt too much.
Yeah, I always like to say, let the market slowly pull you in, right? Day by day, week by week. And if it's going to be a real rally, if this turns out to be a real rally, if we say we get a follow through over the next few days, you're going to have a number of opportunities to slowly put more and more money to work. Now, one thing to keep in mind, because yesterday was a pretty powerful day.
Yeah.
And a number of leading stocks have continued to act pretty well today, too. But the most powerful rallies will happen during corrections.
Right. Yeah. And this is something, we talk about a lot in our presentations. I mean, you and I go out on the road, we speak to investors. And, one of the things that we have in our presentation is, look, the top 10 days of the NASDAQ composite were all during corrections. You look at the dates, and it's 2001, 2008, and these were big rally days. 14%, I think, was the top one.
Oh my God.
It was up 14% in a day.
When was that? Like 2001?
Yeah, I think it was 2001. And that's one of those things where you turn on the TV and you see it, and everyone's like, "Oh my gosh, this is wonderful. Everything is back to normal." And it's like, no, that's the worst days are surrounded. The best days are surrounded by the worst days. And so that's another reason why when people start talking about why you can't time the market, they always say how bad you would do if you took out the top 10 days and how bad your performance is.
Exactly. Yeah.
But they're around the worst days. So, how can you take out the top 10 days and not say anything about the worst days that are surrounding them? It's just so unfair.
Exactly. Now, speaking of a bad day, we had a really bad day on Monday.
Yeah.
Right? And a lot of our stocks really sold hard. And they broke support levels. Now, a number of them have come back over the last few days. But I think the key here is also you're waiting for the fall through day, but you also want to see how the week ends. So far, it's been a very volatile week, but let's see how the week ends, and that's going to give us more insight. Maybe we get that fall through day, but also we'll get more insight on those individual stocks.
Right. And the way I look at it right now is you have to be ready for anything, because this is, we had a rally that kind of started in, right after we broke below the 50-day moving average. So, let's kind of just walk back a little bit to what you and Chris were talking about last week.
Yep.
May 13th, that was our vertical violation where we really sliced through the 50-day moving average in a big way. Volume was heavy, and a lot of stocks were, under pressure at that point.
Yes.
You immediately rallied.
Exactly.
And so, we were like, oh gosh, we really came down hard, and we were thinking that this was our signal.
Yeah.
And then we got an immediate rally, and it's like, oh, that's where you can really start doubting yourself.
Yep.
But then it got back above the 50-day moving average and boom, turned right back down. So that was kind of where we've been right now. Now we're in another rally phase because what happened there, we undercut the low.
That's right.
Of that,
and you undercut the low on that May 13th, the day that you gave the vertical violation.
Right.
Next few days, it rallied up on lower volume.
Yeah, we had 3 days up.
Yep,
and on the NASDAQ
volume,
at least.
On the NASDAQ, yep. Lower volume, barely got above the 50-day. Then the downtrend resumed, undercut the low of that vertical violation day. May 13th.
Now we have to reset our count.
Exactly.
It's no longer, that rally is no longer intact, and now we're trying again. This time now we've gone below the 200-day moving average, a longer-term level of support, and we took out the March lows on the NASDAQ composite. So if you go back to that like 73.32 back in March
8th.
Yeah, so we took that out. It closed above it, I think, that day. I think it was like at 73.33.
Yeah.
Just like by a point. But it did undercut that low. So so now the question is, okay, do we rally from here? Or, is this another one of those cases where you get a few days of a rally and then another leg down?
Yep.
So
and
that's
now
what we have to see.
I think one positive for the bulls, or maybe potentially getting a fall through day signal in the near future is that undercut that you mentioned.
Yeah.
On March. A lot of times if you undercut a previous key kind of support, it's not necessarily a key support level, but it was kind of a significant level because it was a short-term bottom in the previous rally. You undercut that, now you're shaking out even more weak holders, right? And more people are giving up because, oh my God, you took out this level too. So more people are giving up on it. Now when you get everyone out of the market, that's where the market now has a chance to keep crawling higher because everyone who wanted to get out has gotten out at that point.
And that's also where we start looking at some of our psychological market indicators like the fear index, what's called the VIX, the volatility index. When you start seeing rising levels there. Now, the VIX really hasn't, it had a pretty big spike early in May.
Yeah.
But it really hasn't spiked up too much.
Which is pretty interesting.
Yeah. The put call volume ratio, that's another thing we take a look at. That did spike a little, to some of those levels that we often see at short-term bottoms.
Yep.
But there really hasn't been the overwhelming fear. Nothing like what we saw in December. Like in December, that's where you could really see a big change in the VIX. You could see a big change in a lot of these fear signals where people were just like, oh my gosh, and that's how it always is at the bottom. It's, oh my gosh, this could be really, really bad, and maybe it's never going to come back.
Yeah, but I feel like I kind of got that kind of panic or kind of worry by looking at the leading stocks at least. Like, oh my God, they were holding up so well, and all of a sudden the doors open, the floors just opened for those stocks, and they just plummeted, and they just went right through the 50-day moving average, and things like that. So that I think, at least for our kind of investors or people who are looking at growth stocks, that at least did enough to scare out some people because they did breaks. A number of them broke below the 50-day on pretty good volume.
And that's a good counterpoint to what we're seeing right now. We haven't had the floor dropping out of a lot of these leaders. A lot of the leading sectors, and we can talk about this in one of the later segments. software. Now chips. Chips got pretty hurt. That was a big thing. And of course you have
but that was like a few weeks before that's just been kind of
right. But
early May,
that
right?
happens a lot of times where the leading sectors will start rolling over in kind of anticipation of weakness. And of course you've got the trade war talk that kind of accelerated that decline in the chips since a lot of that is back and forth with China. So you definitely have a lot of leaders out there that are holding up well, and so that's why you have to be ready for anything. I think
you have to be nimble. Exactly, and it really is keep an open mind, because the one thing is when you learn to protect yourself in a correction, right? All of a sudden now you start to realize that corrections are opportunities.
Yes,
because the best stocks are going to reveal themselves because they're going to hold up the best relative strength. Maybe they'll break below the support for a few days, but then they'll come back up. On the weekly charts, they'll look good. So you don't want to drift away right now. Obviously, we've all given back profits, given back money, and it is sad and depressing. Right?
But hopefully, if people were paying attention to those signals and paying attention to when the big picture went to market and correction, they didn't get as hurt.
That's true.
And so that's something we'll talk about in the next segment with some of our products.
So let's talk about one other thing very, very briefly here. The vertical violation. Let's just follow up to that. Now, with a vertical violation, usually how successful is the first follow-through day after a vertical violation signal?
It's the failure rate is very high.
Okay.
So again, just to kind of reiterate what you and Chris were talking about last week, that vertical violation is where you have the weakness and then you really kind of get a vertical nature to it. It's not a drift down and I'm just going to meander below the moving averages or support. It's like I'm going to slice through it. And that's what we saw. And a lot of times that just requires more time. So a lot of times, and I'm sure Chris talked about this, a lot of times we have to see maybe 3 months time before that fixes itself. Now, this is a very news-driven event with the trade war stuff, global recession fears now, and you see that hitting the 10-year treasury. So there is a big news-driven component to this, but that is typically what we see, and so that's why a lot of times that first follow-through day fails, and then you start, you don't always undercut the lows, but you do have a lot of sideways action for a while.
So the market is still in a correction. Now, remember, leading stocks are testing their key support areas, so build that watch list. Don't drift too far away from this market because, as we know, the market can turn before we know it. Let's take a quick break, but when we return, we're going to talk about some of our products, how they help us gauge the market environment, so stay tuned. Want to find stocks like the ones on this podcast? A lot of the best names we talk about come from IBD's exclusive stock lists, like the IBD 50 and the Big Cap 20. Whatever type of investor you are, we got a list for you. You can access every one of IBD's lists, plus stock ratings, exclusive analysis, and one-on-one coaching with a membership to IBD Digital. It costs less than $1 a day, but for podcast listeners, we're offering an even better price. Go to investors.com/podcast offer right now and get your first 2 months for only $20. We're back with Justin Nielsen on Investing with IBD. And so let's get into talking about how some of our products help us gauge the market environment. And we can start with Swing Trader, but we use kind of this gauge all the time to let us know if this is the right environment for growth stocks or not.
Yeah, and that's a big thing. You got to start with are the winds in your favor? If you want to use a sailing analogy, and you can certainly trade in any environment, but the odds are very different when you have a market in an uptrend. When I first started investing, it was the late 90s.
Yeah.
I thought I was a genius because everything I touched was gold. I thought this was the easiest game in the world. And I didn't realize at the time that it was the market that made me look so good.
Yep.
I realized that in 2001 when everything I touched was like, oh, this isn't working. So if you can have that market at your back kind of thing, then that makes a very big difference. And so that's where sometimes with our products, because we're putting trades on all the time on our lists and things like that, it really kind of keeps us in tune with what's happening with the market at any given point in time.
So let's go back to last October, in October 2018.
Right.
And with Swing Trader, how many ideas did you have going on at that point?
And here's the thing. It was so funny because in late September, there was a really strong rally, and we're putting things on.
Right.
We had like 7 names on at one point on Swing Trader, and just to kind of let people know what Swing Trader is, it's more focused on swing trading, which is a shorter term investing style.
Right, around like what, 3 to 10 days?
5 to 10 days.
5 to 10 days.
I would say our average holding is probably about 6.7 days. Something like that. Of course, the ones that don't work, they're usually off within under 5 days,
right.
3 days. The ones that work, those can have maybe a little bit longer. Maybe they get held for like 13 days. So it is a shorter term time frame that we're looking at. As a result, a lot of times the stocks that we're looking at, as opposed to the bases that are maybe 7 to 8 weeks long,
right.
they might be 7 to 8 days long.
Yeah.
And rather than using the 50-day moving average as we would for like a position trade, because hey, if you're looking at a couple months or 50 days at least time frame for your holding period, that makes sense. But we are using the 5-day and the 10-day a lot more as the relevant moving averages for us. So it's a little bit quicker paced. A lot of a much shorter time frame, and we also sometimes will use volume. A shorter time frame on the volume rather than the 50-day moving average of volume. We'll say, okay, if this is a 10-day base, how does the volume compare to the last 10 days? Or,
okay.
The consolidation here in the base. So,
so you had seven ideas in September,
right?
Because there was that brief rally.
And the other part of this is we're taking profits a lot of times very early, rather than waiting for 20 to 25%. We're taking profits at 5-10%, and so what was happening was we really got aggressive at the end of September with the number of names that we were putting on, and then we were getting profits on them. It was great. But then what we were finding is at the end of September, we weren't finding anything to replace the names we were taking off. And that's what happens a lot of times. So that happened also back in February of 2018.
Yes.
If you remember that,
there
was that there was that really dramatic correction in February of 2018, and I think our last stock on there was NVIDIA, and we had that, and on the first we took it out, and we were completely out when that quick 11% correction happened in the NASDAQ composite. And that's another example of a vertical violation. Now Swing Trader didn't exist, back in 2016. Well, it started in April of 2016, April 2016, but we had just come out of a correction then.
Yes.
That was another vertical violation, so a lot of times what happens, whether it's a vertical violation or not, you do find yourself naturally getting out with Swing Trader, because we aren't finding things that are looking as compelling. We've taken the profits, and it just naturally gets us out a lot of times.
And how do you use Leaderboard to get this kind of insight? And now Leaderboard is, the way I describe Leaderboard, it's a great learning tool. It's kind of the mid-tier product in all the products. Mark Smith's our top-tier product, and investors.com is the entry-level product. But Leaderboard, now you have a team going through, they're using Mark Smith, finding ideas.
Right.
And they're picking out a few ideas, putting them on Leaderboard, and saying, okay, and what's really nice is they're walking you through.
Yeah.
Right. Here's a couple to handle. This is why we like these stocks. This is how it fits into our strategy.
Right. And that was the whole thing why Leaderboard was created in the first place back in July of 2011. It's because we had all these lists in the paper, the IBD 50 list. It was actually the IBD 100 at the time.
Yes.
You have the Big Cap 20. You have all these different lists, and people were saying, look, that's still a lot, and I still need some help walking through this. And that's kind of what Leaderboard is. So we have a lot of experience on the team, on the markets team. I've been doing this for 20 years, over 20 years now. And I'm still the newbie. Scott Latonen is the only guy I beat, and that's only because how old was he 20 years ago, But
3.
Yeah, exactly. But you've got a lot of experience on the team. People that have been doing this for a very long time, and so I'm the second newest, I guess I should say. So you have. And it's more than just, let's throw ideas out there. As you said, we're kind of, this is why. This is how it fits in the strategy. And where the leaderboard has been helping lately is we've kind of switched our focus to a little bit of a managing it more like a portfolio, because once we got custom alerts, and this was February, I think it was February of this past year, 2018. The ability to have custom alerts to say, hey, we're putting this on as a half position, that kind of changed things for us. We could treat it a little bit more like we treat our portfolios, because as we talked about in the last segment, we don't go all in.
Right.
We'll do some testing, testing of the waters, and that's a big thing. In Swing Trader, on that way down from October, October 4th is when things really got bad.
Yes.
That's when it was like, okay,
and
this
that's
is
when
different.
that's when the investors.com, the big picture, had are under pressure, market under pressure.
Right.
Right.
And so from then until December, January, everything we did was test trade.
Yeah.
Just a single, sometimes a half position.
Yeah.
Now leaderboard, it's kind of, that's more of the position trading, not swing trading. And so one of the things we did with leaderboard was when we started to see a turn, once we had like, oh, we got 20% correction, now we're at a point where we could rally from here. That's where we put on UPRO. Now, of course, UPRO is a triple leverage of the spiders. So it basically, whatever the S&P 500 does, it does triple that. It's a leveraged ETF. But the reason why we did that then was because we were trying to make sure that we were very, had a very small percent invested. We had very few names on at the time because we had naturally come out because of the correction. But UPRO allowed us to kind of manage our risk level versus the S&P 500.
Yep.
We weren't going to underperform the S&P 500 by too much because of that UPRO position.
Yep.
In the same way, what we did this time was we wanted to protect the profits. So on leaderboard, we had over 20% gain for the year very quickly, and we were really beating the S&P 500 very strongly, and we wanted to keep that. So what we did was we put, in this case, SQQQ, and that's the triple inverse of the NASDAQ 100. And the reason why we did that was because we had some stocks that we were still keeping just in case, especially software was such a strong sector. So just in case this was a very short-term correction, we wanted to kind of offset, and we were okay that our SQQQ was going to offset our stock positions, but that was going to keep us relatively even with the S&P 500. So that's the way some of our products, and we explain this, we explain this when we take a position in any of these. We'll say, this is what we're doing, and we can send a custom alert to communicate with our subscribers to kind of let them, get a little insight into why we're doing the things that we do.
Yeah, well, I think another benefit, and I'll speak for MarketSmith, is if you're using some of the same idea lists over and over again, you're going to notice the subtleties and the changes. And so the Grow Through 50, and that's the main list I go through, and you look through that too.
I mean, that's, I think, the main list we all use.
Right, exactly. Yeah, so on the weekend,
it's a very good list. There's a reason.
It's a nice cast, nice wide net. When you're in a good market, it's hitting 300.
Yeah.
That's the max. When you get in a really tough market, the minimum is 75. And I can't remember exactly, but it got close to pretty much close to 75 when we were in December of 2018. Now, once it really sells off and starts hitting that 75, you're already in a bad market. Well, it's almost as a secondary indicator it's become for me, because that's rare. The last time I saw that hitting 75 was in February of 2016.
Yeah. And you also see a change in kind of the names, because it was a lot of. I remember this because this was still when you and I sat right by each other. So we were sitting back to back. I was sitting and you were sitting right behind me. And I remember that we kept on talking about, oh my gosh, what's coming up on the list? Utilities.
Yes.
REITs.
Exactly.
It was, the income stocks. I think I wrote my first income column, and I'm like, what am I going to write about? And it was like, oh, there's plenty on the IBD 50 and the Growth 250 right now in the income category.
Yeah.
So you definitely see a change in what starts appearing on the list.
And so you don't want to necessarily assume when you start seeing that we're going to be in a correction for a long time. A lot of times if you start seeing that, you're like, okay, everyone who's wanting to get out, they're probably gotten out, and now we're waiting for that catalyst and another fall through day. So I use those numbers as gauges. Even the William O'Neill screen on MarketSmith, I think the lowest it went to was like 14. It's usually hovering around 18 to 80 to 100. It was like down to 14, maybe 8 intraday when it got really bad. And so you knew it's kind of like the put call ratio that we spoke about last week, or the VIX that you just mentioned.
And another thing that this is something that a few subscribers started pointing out to us, and I think I saw someone mention this on Twitter as well. When you start seeing the accumulation distribution for the indexes, the indexes, if you look on the general markets page, does have an accumulation distribution rating. When you start seeing that get to E, that's usually something that you will usually see before a
so some of our longtime readers and people who've been there really from day one, Investors Business Daily's launch, they pointed those out. That's very important. They pointed that out to me too, and so you can go to investors.com and the general markets page for that. But all of these are going to act as great gauges when they knock out these great leading stocks. And there's nothing left to buy. Obviously hopefully you already know that you're in a bad market. But when you start seeing that, that turn could be around the corner. And so you're just waiting for that follow through day, and you always want to be nimble. I think that's the big thing that we can stress for this episode is always keep an open mind, even though these things can look really bad at times. You want to keep an open mind because these markets are so resilient. They can change, and in the end, you don't want to let your emotions tell you what to do. You have to let the market tell you what to do.
And you were talking about a Bill story. Can we get a Bill story here? So here's when I first started working for Bill, I was his assistant for 15
years.
Yeah. So
you were the envy of many.
Right.
Justin.
September '99 is when I first started working for him, and if you remember that market, it was horrible. And I had to bring him to the airport. He said, oh, Justin, can you bring me to the airport real quick? And I'm like, oh my gosh, this is the first time I'm driving Bill O'Neill. And I was driving this really dumpy car. It's like a Ford Festiva, like this 3-cylinder car. And he's telling me about his take on the market. He's like, I'm, just bearish. I sent a note out to 500 clients. And 3 weeks later, just a few weeks later, we had a follow through day. And I look, and he's like super heavy invested, and of course, from October '99 to March of 2000, he made a ton of money.
Yeah.
And I'm like, you were so bearish. He's like, it was almost like he didn't remember. He never stuck to his guns in terms of if he had a thesis, once the market proved him wrong, he said, okay, forget it. This is what the market is doing right now. I have to do what the market is doing. And it was almost like he didn't even remember that he had been so adamant about what he thought was going to happen. He was always able to kind of turn very quickly. And so that's what you have to do. Even if you come up with a thesis and you say, you know what, I think this is bad, I think it's going to get worse, you have to be ready for you to be wrong and the market to be right. And if you can adjust to that reality of what the market is doing, you'll do okay.
Yeah, and so the only way you get through that is by looking at enough actionable ideas, noticing the changes, and that's going to give you that great gauge on the market. Coming up next, we're going to talk about a few stocks that are setting up in this market, and also a question from one of our listeners. So stay tuned.
Engaged investors can find profitable trades in up, down, and sideways markets. But how do you adjust your trading and keep your portfolio growing when the market outlook changes? Join IBD for a free investing webinar on Tuesday, June 18th. We'll show you strategies you can use to trade with the market direction, not against it, and find winning trades while protecting your profits. And if you watch it live, you'll get the chance to have your investing questions answered by our market experts. Go to investors.com/webinar to register and save your spot.
We're back with Justin Nielsen on Investing with IBD. Now, Justin, let's talk about some current stocks. But before we get into that, let's start off with our question from the listener, okay? So here's the question. And this is from Mark Siegel. How do you know that a stock is under accumulation when we're in a correction? It's a great question. Thanks, Mark.
Yeah. So a few things that I would kind of take a look at. And this is the reason why this is an important question is because when the market is in a correction, you don't want to just be falling asleep. It's not the time to be disengaged. You want to be ready, and I think you've really drummed this point home today. You want to be ready for that opportunity when it comes. And you don't know when it can come. I mean, 4 days, 4 days from the bottom, it can come as early as that. So
Right.
you have to kind of have your watch list always fresh. And so what you're looking for, there's a few things you might look for. One of the things I really like to look for is, the stronger stocks. So strong relative strength, what's holding up, being aware of that. We have the accumulation distribution rating. And that, of course, I mentioned that for the indexes, but each stock also has an accumulation distribution rating that tells you, hey, what is the volume like on the downside versus the volume like on the upside? And that can be a good gauge. But I think if you just want to use a chart as a picture, tight action is generally what I'm looking for. When you see that wide and loose action, that tends to mean, hey, this is going through a lot of price discovery.
Yeah.
But when you see
a lot of volatility.
right, a lot of volatility. But when you see the tight action, and this could be something that was volatile and now gets tighter.
Yes.
Those are the things that I'm kind of looking for in a correction to tell me, hey, this is something that could be special and could be setting up for the next move.
I think another easy way to look at it is some of the stocks that you missed on the previous rally.
Mm-hmm.
They're like, and they went up on these great runs, and
Right.
you missed it. This might be your chance to get into it. So they may come down pretty hard. It might be wide and loose initially, really long price bars, but then they tighten up, and they tighten up around a key moving average, like the 10-week moving average.
Yeah.
They go sideways. Their relative strength line is still strong. Their relative strength rating is still pretty high in the 90s.
Mm-hmm.
The higher, the better, too. That's one thing I learned when I came in-house. It's, 90 is good, 95 is better, but if it's above 90, we really want like 97 and 99.
Yeah. Mm-hmm.
So those two, and then, of course, usually the first ones that form a base
Right.
are the ones that could be the next leaders in the next
And
rally.
the first ones that break out.
Yes.
This is something I learned very early on too. In 1998, I remember Charles Schwab was the one that broke out on the follow-through day, and that was the one that Bill nailed at that time, and had a 400% gain on in 6 months. So being ready and being able to buy on the follow-through day on those stocks that are setting up is absolutely critical. And it's going to vary, because if you have an intermediate correction, that's where we are right now.
Right.
We've corrected 10%. That's the intermediate correction type. That doesn't necessarily flush out a whole new brand of leadership. So you could have your leaders come back, and those are, as you said, the ones that are getting support at their 50-day moving average. Usually when you have a more serious correction, that's where you see a little bit more turnover in the leadership, where what led before tends to not lead again in that next cycle. But intermediate corrections, that's not the case.
And one thing that we've spoken about a lot during this podcast, a number of the episodes, the leading stocks, it shouldn't be a surprise anymore, the software stocks.
Yeah.
Right? So those are stocks that if you want to see if they're being accumulated, or you want to definitely pay close attention, especially this week.
Mm-hmm.
Right? So we spoke about earlier, Monday was a really bad day.
Yeah.
And so a lot of these software stocks got hit, broke the 50-day.
Broke their 50 days hard. Mm-hmm.
Right. Yeah. Now the last couple of days, they've come back.
Mm-hmm.
And so if you look on a weekly chart, they look pretty good right now.
Mm-hmm.
Unfortunately, we have 2 more days left in the week.
Yeah.
So let's see how they form. And then, of course, let's see if they start doing the tight action and kind of get quiet. Because a lot of times when it's that quiet kind of period, that tight action, everyone stopped watching them. Mm-hmm. And that's another kind of key. The ones who are slowly accumulating are the large institutions.
I was just going to say that. That's where that accumulation, and of course Bill used to say this all the time. That he used to call it the stealth accumulation. When you see the 3 weeks tight, and you see that tight action, this is where the institutions that understand the story, that have their analysts out there kicking the tires on all these companies, they're looking at the opportunity of, hey, I can get some more shares, and so they a lot of times will absorb that selling. And so it is that quiet accumulation. And it's not like everything broke below its 10-week line or a 50-day line. I mean, you had stocks like Team that did hold, right at the 50-day line.
Yep.
And, so you did have some of them that held. One thing that I'm looking at is that there was really heavy volume on the break, a little bit lighter volume as these are rebounding. But as you mentioned, that's what you're seeing on the daily. On the weekly, you're still seeing some pretty tight action, and maybe tight action on those closes. And when you see the tight action on the closes, which we'll find out at the end of the week, that can be telling you something about that quiet accumulation.
And I think that also emphasizes the point why you want to look at both time frames.
Absolutely.
Right? Always look at both daily and weekly, because daily tells one thing.
Right.
but the weeklies tell another. And so we'll see who's right. You know, at the end of the week and also over the next month or so.
Sure.
Okay, so let's get into current stocks, and so we'll talk about a couple stocks that have been, I guess, on the radar, everyone's radar, right, and in the news. The first one, and this one started acting even better today. The last couple of days it started acting better. Is Uber.
Yeah.
Right.
Yeah,
and so hopefully most people who are listening to this podcast know about Uber now. I remember Uber was just mind blowing the first time I took it. I think it was like in 2014. This is when we were doing a trading summit at Chicago. It was like the first trading summit we did.
Was that with Christine? Maybe
it was back. I think so. Yes.
Yeah.
And we had
she
like
was the one that ordered it.
Oh, yes, exactly.
Yeah, because she's a millennial, and so she's like, oh, you know, she's using Uber all the time, and you know, you and I are like, what? You know,
it was mind blowing.
You're gonna have a stranger pick me up, you know,
some random car came.
Right,
we don't
exactly.
know who he is.
You know, guy shows up, and this isn't a yellow cab. This is like, you know, this guy has a car seat in the back. What's going on? You know.
But it worked. We weren't murdered.
Yeah.
And we're still here. But
and she just paid for it. She got the receipt, which I mean, expense reports, you know.
Oh yeah,
keeping track of the
It
receipts.
was all just emailed, right? We just walked out of the car.
Yeah, and yeah, exactly. Like, well, the poor girl had to tell us, no, it's okay, you're fine, because we're looking around like, what's going on?
Exactly. So really, at that point, when you experience that first Uber ride, it's mind blowing, right? And it's game changing. And so that's what you want to get in the habit of. It's like, wow, this was a pretty revolutionary experience that we just went through.
Right.
Now, finally, they came out public. Obviously, everyone knows about them. Their market cap is massive, the largest probably IPO ever, I think. But they sold off like so let's just briefly talk about IPOs here. We're not going to go out and buy an IPO right on day one. Right?
Not going to touch it. Yeah.
We're going to wait for a
never
setup.
done it, never planned it.
And so just like Uber, we waited, right? And so we're going to wait for a setup. Now, the earliest type of setup that we can get when you're using a pattern is an IPO base, which is a really short pattern. I think 15 days is the shortest.
You know what? Actually, Mike said it could be as short as 5.
Okay.
Yeah, I think Ali corrected me on video one day. Yeah.
Oh, wow.
7 is, you know, I know that we could go down to 7, but there's a rare few cases where 5.
Okay, so I think so Uber formed an IPO base. And it's picking it up in MarketSmith, and it broke out of the IPO base today.
Yeah.
So $45. Now, Uber doesn't have any earnings.
Right.
Right. And their sales are okay.
Yeah.
Right. And they're losing billions of dollars each quarter or something. Right. But the story's there. Obviously, the story's there.
Right.
They have the huge brand name. And people don't say, I'm going to go and use my mobile phone and get a car, call a car. I'm going to Uber.
Yeah.
Right.
In the same way that Google became,
exactly.
You know, yeah. Absolutely.
So I always love that when people are just kind of turned into a verb. It's so that now obviously it's not just the other interesting thing with Uber is it's not just hailing down a car, getting a car almost instantly these days. They're doing Uber Eats, right? So now that's, I think from what I read, that's the biggest delivery service.
Yeah.
Bigger than Grubhub and all this. So they're doing that. They're looking into self-driving kind of cars.
Right.
They're taking this huge kind of user base that they have, and they're figuring other ways to monetize it.
Other ways to serve them. And, you know, the monetizing is the big thing. I like how you said
serve. That sounds a lot kind.
Yeah. So the big thing, though, is monetizing. And this just reminds me of when Facebook came out. Facebook, of course, everyone knew about Facebook when that IPO. I mean, everyone was so excited, you know, in the same way that they were excited about this one. But what happened there, and if you pull up these charts, folks, you know, on MarketSmith, you can go back in time, you can do a change date. Facebook came up to 45 on the IPO date.
Exactly 45.
Exactly 45, and then it pulled back and didn't do anything for a year. And it didn't have earnings, you know. And so one of the things we were waiting for was for it to have earnings, was for it to form that first base. When it finally did, we were all over it. We weren't touching it before that. Now, Uber, you know, in this case, it got on its IPO day up to 45.
Exactly 45.
Exactly 45. It's now gone through a base, and it's broken out. It's not doing this 1 year long, you know, let's see. So now, granted, what Facebook, when it finally got on our radar as, you know, it's formed the base and everything and it looks interesting, it had figured out that monetizing, and its earnings I think grew 55%.
They figured out mobile.
Yeah,
right.
and advertising was the big thing.
Exactly.
So, who knows how long it's going to take Uber to figure out that profitability aspect, but if they can show more ability to monetize these different things, that could be very interesting. But on the technical side, the chart is looking very interesting. The fact that it got above that 45 level today.
Yeah, and now one thing to keep in mind: IPO bases, they're a shorter base. The failure rate is higher, and so keep that in mind.
And we
There's
are
more
still
risk.
market in
And
correction.
we are market in correction too.
But these are the things that you have to have on your radar, because these could be the opportunities of the future. So this is the good time to do your research.
Okay, speaking about the future, now the future of the way we're eating or things we're eating obviously continues to change.
Right.
Now, an interesting new stock has come out recently, last 3-4 weeks. Beyond Burger, BYND.
Yeah, Beyond Meat.
Beyond Meat.
Yes.
That's right. Because
You're thinking of the products.
I am thinking of the products and I tried it last year. And it was I originally guessed it was the burger patties.
Yeah.
And they were pretty good. You throw them on the grill and versus the veggie burgers.
Right.
Definitely an improvement. Still not as good as a regular burger.
But there's definitely that aspect of getting the texture a little bit better.
Exactly.
I mean, a veggie burger, it was like, okay, that's not even close, type thing. The texture and everything. But
that's too many vegetables.
Yeah. Now it's still vegetables, but they're definitely getting a lot closer to the look, taste, and feel.
Right. And so they have the Beyond Burger as one of their products.
Right.
Now they also have Beyond sausages too, which those aren't bad actually too. So it's a really so talking about kind of a game changing kind of product. It's an improvement over, and I guess it's building a better mousetrap for the category. They don't want to eat meat,
right?
But they still want to have a barbecue and still participate with all the meat eaters out there. So it's gotten a lot better. So these guys came out May 2nd. Right, and they've done pretty well. It's pretty much a rocket ship so far. These guys haven't. Beyond Meat has not formed any type of base just yet.
Right.
On this, so we're waiting for that.
Well, and here again, this is what Allie and I were talking about. We actually, in the video that we were discussing, one of the Stock Market Today videos was Beyond Meat as a potential IPO base.
Yep.
And so this one was kind of coming out of something. It ended up being very short.
Oh, so okay.
Yeah, so
that's right. Okay, so this is where so this is the short, really short IPO base, right?
And it did break out, but then it didn't go anywhere. Again, we have the market pressure. That's probably an aspect of that. But now it's right back at new high. So this is one that's definitely trying to buck the trend.
Yep.
The market is trying to hold it back, and it's like, no, you can't hold me down, type thing. And now this is another one that doesn't have earnings growth at this point, but the revenue growth on this is triple digit. And this is something when Chris and I are looking for ideas, a lot of times, when we see that triple digit phenomenal revenue growth, that can really be something that entices us into some of these IPOs.
So this is definitely one to keep on your watch list and see if it forms, gives you another, maybe more of a traditional base now. But it has gone on a really great run. RS ratings at 99. And so it has definitely been bucking the trend.
Right.
So keep your eye on the IPOs and the software stocks. And remember to keep your watch list fresh, because this market could turn around. We could get a fall today in the next week or so. Who knows? And so you want to be ready. So thanks, Justin, for being here.
It was a lot of fun.
That's it for this week on Investing with IBD. Next week, we will have Charles Harris, longtime portfolio manager since 2000.
Yeah.
And
we used to sit next to each other.
Oh, did you? I thought we had our special little moment there.
Yeah. Before you, it was Charles.
Well, Charles will be here. Justin won't. And Charles and I will talk about pullback trading or buying on pullbacks.
Yeah. And he does a lot of swing trading too.
And so it's a perfect kind of continuation of what we spoke about today. I'm Arusha Pires, and thanks for listening. And for this week's notes and charts, make sure to go to investors.com/podcast, where you'll find details for each episode in the podcast episode section. And make sure to subscribe, rate, and review our podcast if you haven't already. We'd really appreciate it. You can also send us your questions and comments to investingpodcast@investors.com. We would love to hear from you and may use your comments on an upcoming episode.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube.
If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.